There we go. Hope that's come up for everybody to see. All right. So good morning. Thank you very much for taking your time to come and listen to our update on what is the closeout of the fourth quarter of FY23 for June. Delighted that you could make it. Myself, Trent Lund, CEO of Wrkr, and of course, Karen Gilmour, our CFO. What we propose to do this morning is we'll run through an update. I want to take this chance to do a reminder for people and level set about the core premise of the business and what we do. We'll be putting this recording up on our website. That'll give people an opportunity to come back and look at it. We'll run through the presentation. And then at the end, I'm trying to leave as much time as possible for open Q&A. For those who've been engaging in these calls will know I'm fairly transparent. So I like to, if you've got questions, pop them into the Q&A section, and we'll get to it. I've already had a couple of emails directly, so I've put some topics up just to get the ball rolling at the end. So without further ado, why don't we kick off, and I'll run you through. So, a reminder that the space that we are very much in is revolutionising workplace compliance. So we do play across a broad spectrum from hire to retire, with a very specific focus and strength around onboarding employees into organisations, onboarding them into the payroll, onboarding them for super purposes, so setting up their superannuation choices or stapling them to their original super, all the way through to then continuous compliance for employees. What makes us unique and a real focus of our business is we deliver this over a mobile branded experience, so branded in the companies that use it, delivered as a mobile experience to end employees, and specifically, the way we describe it, designed to be used on the bus with your thumb. Try and take the errors out by doing direct attestation to the various federal state systems that are required. So certainly employer branded, mobile friendly, but secure and geared around the consumer owning their data. The technology itself is very much a one-stop shop for compliance from that onboarding to pay. We've invested fairly heavily in this aspect of the business to ensure that we don't miss the cross-sell and upsell opportunities. This is particularly important for our business as we start to bring on more superannuation contracts, working with the large super funds to ensure, as we're providing clearinghouse and super contributions, in that same interface, we have the ability to cross-sell and upsell our broader, from single touch payroll through to broader onboarding and broader pay services beyond the super contribution. That all delivered off a single platform, but very much built API first. For those there's plenty of buzzwords in the world of tech, but for all intents and purposes, we are designed to connect. So if we can connect to a compliance moment for an employer to give them a richer dashboard, a richer experience about their employees across that hire to retire, we will. And if it's something we can't provide, but they can get elsewhere, we can connect to those services. And that really creates that single interface view, particularly for the Chief Risk Officer, for the CFO of businesses. And of course, Wrkr connects to all the relevant regulatory services, and very much so our customers don't have to. The reality is this is a scale game. The level of requirements for a business to deliver the services we do means you really need to be serving a large volume. And so that's very much the mission. It actually, importantly, from an investor perspective, creates a moat around our business that makes it harder for new entrants. If you look to the right-hand side of the screen, you'll get a fair indication. A couple of recent additions there, but you'll see ID Match has just been recently added. That's yet another government service that we've just passed the various requirements. Obviously, also announced recently was our CDR, consumer data rights, to allow us through our third parties to access open banking, again, requiring fairly stringent requirements. And obviously that talks directly to security. We've spoken about this for a while, but I do get questions, so I wanted to just touch on this quickly today. Around everybody is very focused on cyber risk. We are well aware that we deal with very critical data, and on that basis, we've taken a rigorous approach towards cybersecurity. Just a couple of things I'll call out. Obviously, all data being encrypted in transit and at rest. User control and data-driven consent. So we have designed our solutions to allow the user to own their own data and make the decisions on permissioning their data, which sits very tightly with the Australian data privacy laws and also GDPR within Europe. Continuous monitoring. Many companies will claim ISO SOC 2. These are typically done every 2 years or 1 year at best, with the occasional check. We work with a third-party company that allows us to monitor our controls on a real-time basis. So we get a full visibility of through our Trust Console of where there are any potential issues or emerging issues, and that is very much setting a standard within Australia. And then finally, the concept of shift left and zero trust. So we have engineered, both from our own developers accessing data all the way through to clients, a zero trust model, which means we have continuous walls that we put in front of people to ensure that they can attest to exactly who they are before they can access records. And if you could access a record, you can only access one at a time. So no wholesale access. So fairly important. So we just wanted to share that because we do think that is it's a high cost for all businesses, but it's something that we have really decided to be very much a leader in our space. As you know, we're already delivering on the vision. Our numbers are large in terms of who we touch, but really still for us, we very much see this as a starting point. We are fortunate to have a wide reach today, but this is very much where our focus is to grow that and grow how many meaningful moments that we're connecting with employers and their employees. So with that as a backdrop, I'm going to get Karen to talk you through where we're at from a financial perspective, and we'll just unpack that in a little bit of detail for you. Karen.
Thanks, Trent. Hi, everyone. As you can see in front of you, financial highlights are looking really positive for this financial year. We're really pleased to see the improvements across quite a number of our financial metrics year on year. If I break it down, if we look at revenue first, we saw that our transactions and platform business remained really stable in FY23, with the growth in revenue of 43%, really driven by our initial contracts with Link and the work that we've performed there. We've contracted 800K to date, of which 530K has been delivered. Our SMSF hub has performed extremely well. We continue to get new intermediaries as well as trustees directly signing up to that service, with amazing feedback in terms of the user interface and the ease of performing rollovers required by the rollovers 3.0 regulations. So we've seen the lift in SMSF income there go up to 615K, gives us a really good starting base going into FY24 on the ARR there. And then thirdly, we've seen interest rates rise, which hasn't been great for some, but good to see that float income coming back into the business. And we expect to see that continuing into at least the next financial year. So yeah, great result on our revenue growth. I guess, when we talk about Link and what we've done so far, that's the detailed detailed planning and implementation parts, and was positioning us to kind of execute the contract quickly as we move into kind of discussing the commercials and continuing that discussion with Link. The revenue base just demonstrates the high retention of customers with no churn in our large platform customers, and minimal churn in our super and STP transactions processing and SMSF hub customers. So that's kind of set us up with a good ARR starting position going into FY24. We've had investments in this year in development of our features for the Wrkr Ready onboarding solution, including the digitization of the superannuation choice requirement that Trent mentioned earlier, for employers and employees, contractor workflows, and other identification and verification checks. So we're really glad that this has kind of been embedded into our platform, and our customers will be able to activate that when needed as we go to market. Really improves that opportunity to grow our ARR revenues more quickly in FY24 and FY25. So FY24 will see our investment in onboarding customers to Wrkr, as well as to position ourselves for that continued SaaS growth in the business. So that hasn't come without some investment in cost and having to manage that cost to revenue relationship, especially with the delays in the the Link discussions and progressing that as quickly as we had hoped. But the team has done an incredible job of managing the resources and directing their attention to the areas that should assist us to build that sustainable business moving forward. So the cost management has been balanced with key investments in product development, as I mentioned before, the feature functionalities there, as well as increasing our geographical reach, so enabling the platform to go international, and also using it as a platform that is a multi-cloud hosting ability. So really opening that up to all future customers. We've had some efficiencies in operations. We've done that through ensuring that we've used software tools effectively across the business to communicate and also to manage our projects across the business. We've had, a high cost, I guess, in maintaining all those certifications that Trent had up on the screen earlier. And, that's our GNGB certification, our AFSL audit, ISO and SOC 2 certifications, and maintaining those and ensuring that we're able to provide the services that we do. And then, as Trent mentioned before, we've had the investment in kind of maintaining that cyber posture and making sure that we're up to date and wanting to be the leaders in that space. We've also had some good investment in our people. So we've seen the product manager, which I've mentioned in the previous quarterly. We've now got a customer success person on board. We're increasing our development team in all facets, including, quality assurance and developers. So we're really seeing that team, we're humming together as a business. And I think that investment has been fantastic. So then if we kind of move on to the key takeaways, I'll pass over to Trent to talk us through those.
Yep, sure. And I wasn't going through your moving your slides quick enough for you, Karen. Look, I think Karen explained and went through. I just touch on one or two things on that revenue growth. Firstly, impressive that really the team, drove hard to hit that target while still doing an enormous amount of work behind the scenes to prepare ourselves. Karen did touch on a couple of things there I just want to highlight. We spoke about our investment in from a technology standpoint, it's called containerization, but effectively taking our platform to ensure that it has two elements to it, which is one, it is multi-cloud. That means can be deployed in either Microsoft Azure, Amazon Web Services, or Google, or any private cloud environment that supports Dockers and containerization. That means it is far easier for us to deploy, a much lower cost for us to deploy within new environments, be competitive on our rates for existing cloud suppliers, but more importantly, be able to deploy in multiple regions with minimal change. And in particular, that is about preparing us for offshore use of the platform. So that is substantive, but it also adds reduces our total cost to run the platform over time, and also increases the security of the deployment of the platform. So just so everybody is aware, while we're working behind the scenes rigorously to grow the business, nobody is standing still in terms of the ongoing development. So in terms of those costs, I think Karen picked that up in a fair amount of detail. So let me just touch on what we believe are the key takeaways, and then we can get into the meaty bits, which I can already see questions starting to coming through. But I think obviously we've been able to. We're a small organisation, but we have still been able to focus across the breadth of the business. So ensuring that our cash management is strong, our cash collection side and the basics of the business is strong, while still investing in improving our operations, in particular that cyber posture. Those 4 points I spoke about on the page earlier, you can hover over them quickly, move through them quickly, and they don't sound like much. It is significant and important for a business such as ours. Obviously, Karen mentioned, but starting this next financial year with 4 million in the bank, a solid opening, annualized recurring revenue position, is important for us, and we think that certainly the continuation of some of our larger projects that we have, such as ART, and also the current pipeline, as well as Float, we expect that to continue in FY24. So the base that we built this year really becomes the new base of momentum moving forward. And then obviously new contracts, which we are expecting to bring on board, will then drive the increased side of the business. Important to note, just on the ARR number, we've taken some fairly key decisions, which is to manage our position. We are very much trying to balance, and we are using some services revenue, particularly around onboarding new clients or innovation work with new clients. We think that's the best way to run the business and be as close, move as edges towards profitability. If we had a larger investment capability, we might have run things differently, but we think this is a diligent approach and better for overall shareholder return, most certainly. Certainly on a couple of finer points, we'll talk about in a second, but we are very much looking forward to completing the final negotiations with Link and shifting from discovery phase and the detailed planning into actual implementation. We are an engineering business, so our team want to be in there busily building, and we're very much expecting that to be the next phase that we move into, subject to signing final contracts. And I just want to touch before we get into Q&A. I could not be prouder of the quality team that we have at Wrkr this year. We knew there was risk going into the year, that large multi-year, when you're talking about up to 10-year period contracts, they go for a long time, but they take a long time to sign. So no stone was left unturned. The team worked very diligently across all facets of the business, while continuing to progress where our larger deal flow is, as well as building out our reputation with other providers in the market. So a lot of business development activity continuing to go on just to shore up our position. So just want to make that mention. There is circa 35 people who are who I don't think they could work any harder than they do for their shareholders. So on that basis, why don't we jump into some Q&A? There's some already forming, so we'll jump into Paul. Great question. Before I go into the next, I put a couple of questions up as well, but I'll just pick up a few that have been raised. So the staff and administration costs being circa 6.7 million, which exceeds our cash receipts. Do we expect those costs to decrease, maintain, or increase going forward? So there is obviously a portion of that core costs of being listed. We are very much geared around, I would see they are the base costs. We do expect them to grow, but grow in line with bringing on revenue. So this is the implementation work to come, though our costs do not scale with revenue. So we expect that we'll go to a peak. We'll be close to that peak of our total costs this year, and we will then see revenue outstrip costs. We are very much engineering and moving the business towards EBITDA positive by the end of FY24, so coming into the start of FY25. We want to be in the position of self-funding and driving our business forward. Glenn, given success, there it is, of SMSF Hub, are you considering offering a similar direct version of Wrkr Pay? In fact, we are. Some of you may not have seen, the updates came late on the website, but certainly Wrkr Pay is where we've been doing a lot of work in our product. We already do provide pay services through the Click Super brand. There were some substantive changes that we wanted to make, which is ensuring we had a few more pay options around the various pay rails, and also integrated into the branding. So we provide STP, single touch payroll services today. We've now extended that, and really that is a core part of our proposition moving forward with super funds. So we can, under the SIS Act for the super funds, we can deliver on the contributions paid for by the super funds, but we're in a position to make it very easy for an employer to turn on the either STP or pay, and then pay our pay worker directly for that, which avoids any breach of the SIS Act. Glenn mentioned the release potential expansion into Hong Kong. Is this expansion dependent on Link? Yeah, so look, we're already doing some work up there in high-level designs. Yes, the ideal entry point for us is via Link. That said, the current work is giving us exposure to quite a few other players in that market, and we do believe our proposition is a neat fit. So that'll be something we'll focus on. I do want to balance, as exciting as it is, Hong Kong's a small market comparative to Australia and what's really in front of us right now. So, we'll balance our effort in going after it. And then another one, Glenn, you're active this morning. How do you expect the integration of Wrkr platform to Workday? Oh, well, there we go. So let's jump into payday super reforms. It is an interesting question. So for those who aren't across it, July 2026 is the start. So, FY27 is really the benefit year. But in effect, what the government is trying to do is get superannuation aligned to pay. That makes it easier to calculate and ensure that employees aren't missing out. It stops businesses failing and carrying unpaid super. There's a host of reasons for it. It will bring a level of efficiency and remove fraud and error out of the system. But what it will do is actually lift the amount of super contributions processing fairly dramatically. some companies today process 4 times a year, so each time they do a BAS. If those companies have fortnightly staff, they will be looking at about 26 payments per year. We obviously charge on a per transaction basis because that's how our costs are built in. So it does suggest a large increase to us. I wouldn't suggest that all companies will move to that. It would probably be, somewhere in the midpoint is our expectation, but a large jump. So look, it's a good reform. Probably more exciting for us is it's difficult to become a superstream provider. We are in a very unique spot. So that gives us the opportunity to cross-sell into doing full pay, which obviously has higher float income, but also a higher transaction fee income. So today, most payroll clerks have to alternate between 2 different systems to achieve their outcome. So we think it's a great opportunity for our business. And before anybody asks, yes, all of our contracts are designed to ensure that we do charge on a per transaction, and we do not have caps in that. So I'm going to throw one to you, Karen, which is from Steve, which is just revisiting cash burn rate after reading small print.
I think I can probably take the next 4 there.
Good on you.
Give you a little break. So John, where does the Link discovery and planning revenue sit? And was it most likely in the second half? Yes, it was. So we had some of the revenues in FY22 towards the end of the year with some initial scoping works. And yeah, we've been working through that detailed implementation and planning in the second half of the financial year. So it's great to see those works starting to be invoiced out and billed, and that cash coming in. So there was quite a lot happening in the last quarter, and we'll see that cash come in also in Q1 of FY24.
Right.
Steve, just revisiting the cash burn rate after reading small print, is it correct to say that 132K out is the raw cost to open the doors on a monthly basis? Yeah, so we've spent a little bit of time obviously looking at this, the cash burn rate and what is included and what's excluded, just ensuring that it really is kind of like an operating cash burn. So yeah, the answer effectively is yes. We've excluded the capital raises, the costs on those. We've excluded the R&D that can be quite lumpy. So yeah, I think it gives a really good indication of where we are, and we're only looking to improve that moving forward. I think also you could see the difference in my financial highlights between where we were last year and this year, and that improvement, albeit, I feel like it's marginal, but we're definitely moving in the right direction. And on to, can you expand on what the 440K in investments represents? Yes, so that's capitalization of development costs. That was really around what we were mentioning before around the platform becoming, making it geographically accessible for offshoring opportunities, and then also with that multi-cloud capability. So those costs, they're the costs that relate to that investment there.
Yeah, just importantly, we used a third-party software company to assist with that, just so we could accelerate that program through.
Does our IRR calculation include float? No, it does not. We didn't feel like that was appropriate to include in the ARR, given that, obviously we didn't have any float income effectively last year. It's great that we have, interest rates now, and that's part and parcel of our income this year. But yeah, we don't want to look at the business like, it's dependent on that float income. We're really looking at, what's our real core ARR. As we all know now, we're not really sure what interest rates can and can't do. And so, yeah, we've excluded that for these purposes.
Just important to note, I mean, we want to be very cautious not to engineer ourselves to be fully dependent on float. It's great income while it's there, but I think the business fundamentals have to be strong enough without float that gives an opportunity to return greater value in a short period, but it's very difficult to sustain and not something our business can control, at least what the interest rates are. So that's just so you know, our management view. There's a question here on Super Choice being on the market. Look, yeah, we've heard rumours. I don't want to be drawn into comment on a competitor, but look, it's healthy when there's activity. It shines a light on our industry and our value as a business. I certainly feel we're a business that has gone a little unnoticed, but we do expect that that starts to change when you look at pending contracts and numbers. So yeah, we'll be watching it closely, but again, we'll keep focusing on our fundamentals. It's hard to tell who that interest will be or what that'll do in the market at this point. Luke, let's jump to the big question, which I have up: Link Group and the MSA progress. I do like the way you ask your questions. When will it be signed, and how much are they? Obviously, I can't comment on the how much until we have ink on the paper. What I would say is this: Link have a very, very rigorous and thorough in their approach for a couple of reasons. One, this is not, there is a fair amount of upfront investment required to implement our solution. That does come as a cost. It does put some, it's a risk to them. And so they have to be considering this to match the terms of their contracts, which is 5 years plus 5 years. So they're looking at a solution that can see them out over the next 10 years. So, yep, it takes time. I think, though, to be very, clear, if in terms of where is Link and where are they at, I think the revenue numbers give you an indication. It's a fairly substantive investment in discovery, which talks to that process. Over the last couple of months, it's been publicly reported that Link have lost one of their clients in Hester. Obviously, that has required a fair amount of rework to suit the volumes and the way we had structured pricing. We've worked collaboratively with them to resolve that. So, we're happy. Would I have liked it to be done 6 months ago? Yes. Would we like to be actively in the market? Yeah, of course. But we are the smaller organisation, and they're cautious, and they are doing the right things. There is nothing in our progress together that concerns me about its eventual conclusion, and we certainly wouldn't be talking this confidently otherwise. I know there's a question there, so let me just jump to. It's a tough question. So, been here a long time now, hearing blue sky stuff. Most recently, Sandland, cap raise. Still hearing blue sky. Look, reality, I don't think anybody's being given blue sky. Let's be really honest here. This is a very, very strong business that has had substantial improvement. It's had over 40% year-on-year growth for revenue. It has had that growth while continuing to cover its own internal cost of merge. It is in a very strong position. Now, unfortunately, though, it has asked for patience from shareholders, and we acknowledge that. I have seen, there are probably an even mix at the moment of shareholders increasing their positions and some shareholders who have lost patience. I can't make the shareholder decisions for you. What I can say is this is a business that has very strong fundamentals. We're very proud of it. The numbers that we hit this year, which is really absent of the deal we've been negotiating with Link, still proves a very strong fundamental business. That said, we wouldn't be here and on the journey and the caliber of management team that are working in this business if not for the larger opportunity that sits in front of us. So I don't want to give anybody further blue sky. I'll just be transparent with you. It's a business we're very proud of. We're bullish about it, but each investor will have to make their own decision on that basis. Just a last couple of questions with clients moving from Link to other providers. How does this impact Wrkr? Yeah, so to be clear, we've signed all of our current contracts and negotiations are designed. We don't provide any exclusivity, which means we can continue to work with other third parties. I think it was none of us are inside the boardroom, so we don't see the decisions until they're done for someone like Hester moving away. That said, they've gone to Grow Inc. We have a good relationship with Grow. Our head of product is ex-Grow. We will continue to have strong conversations, and we do want to service that larger portion in the market. We feel we've got a value proposition that they will still be interested in that is somewhat independent of which administrator they use. So for us, it's an opening, not a closed door. It just means that the current negotiation does not include it. And then a final question here: does Link Group announcement regarding cushion in the UK filter through to revenue for us? Look, not immediately. I wouldn't hold our breath on the UK. I think in timing, I would say Australia, Hong Kong, UK in terms of where we'll see market activity, where our gateway services are really relevant. The UK is yet to adopt that same model. So I would like to I'd like to see the UK start a little sooner. We've already started participating in conversations in that market, and fortunately having Emma Dobson on as our chair, having lived through the decisions that Australia made to gear itself up around a gateway model, has put her in a good position to start to share those insights. But long play for UK, so I certainly wouldn't get excited on there yet. So that's not bad. Don, I see you've got a raised hand. I didn't know if you had a question there you wanted to add into the Q&A. And I'll give a minute. If not, no, all good. Look, I would say to all of you, we are very excited by the business. I share with you frustrations on timing. Certainly with our major contract, I think a couple of positives. There's an MSA in place. There's work continuing to be done, funded work, which moves us forward. But we also, our appetite to move very, very quickly is not matched necessarily by the conservatism of a large managed service provider that isn't just thinking about the next year to 2 years. They're trying to plan for 10 years out. So we'll hold our patience. I feel that will be rewarded for both us and shareholders. So I want to thank you all for supporting the business and actually being on these calls and asking your questions. A last little reminder is, for those, some of you I've seen you log in already, please go in and connect and register yourself with the Investor Hub. We will continually push information out through that service, particularly things which don't meet the requirements to be on the ASX platform for notification. So again, on behalf of Karen and myself, I want to thank you all for participating and wish you a very good day. Thank you.
Thank you.